Hello everybody, my name is Peter Petrov, and today I'll be presenting information about S-Corporation termination and operating issues. This is on Chapter 11, Learning Objective 2 and 3, pages 7 to 11. Today's date is November 18th, and the course is Business Accounting 251. Today we'll be talking about S-Corporation termination, about short tax years, S-corporation re-elections, the accounting methods and periods that they must use, income and loss allocations, and then lastly, separately stated items. S-corporations terminations frequently create a short tax year for both the C and the S-corporation. We must allocate the income between the C and the S-corporation, and there are two methods that we can use. The first one is a daily method. In this method, we must allocate income for the full year between the S corporation and the C corporation based on the number of days in each short tax year. Or we may use the corporation's normal accounting rules to allocate income to the actual period in which it was earned, or also known as the specific identification method. Here is an example presented to us in the book. This corporation elects to terminate his S status on June 15th, as given here. This means that January 1st to January 14th, there's 165 days. And then June 15th until December 31st, there's 200 days. So using the daily method, what we need to do is take 165, divide by 365, and then multiply by that by the whole income, which is 365. So you can see we have 165,000 for the S corporation short tax year. That's because up until June 14th, that's when it was an S corporation. And then for the C corporation, we have a short tax year of 200,000. So we take 200 days, divide by 365 days, and we multiply by the full amount of 365, and that's what we get 200,000. If we use the specific identification method, then we just take the amount earned as a S corporation, which is 100,000, and then the amount earned at the C corporation, which is 265,000. An S corporation that has lost its S corporation status must wait until the beginning of the 5th year in order to select the S corporation option again. There are two conditions which IRS actually allows earlier election, and that is if the corporation is now more than 50% owned by shareholders who were not owners at the time of termination, or two, if the termination was not reasonably within the control of the corporation or shareholders and was not part of the planned termination by the corporation or shareholders. So here's the example given in the book. We have a corporation that elected to terminate this S election on June 15th of 2023. So they must wait 5 years, which means that they have 2014, 2015, 2016, 2017, and 2018. So they can elect the status again in the beginning of the year on January 1st. Now we'll talk about accounting methods and periods. For an S corporation that previously operated as a C corporation, all the prior accounting methods carry over to the S corporation. The S corporation does not have restrictions on using the cash method, so that means they can use the cash method, the accrue method, or the hybrid method, with some exceptions. And also, S corporations may use the calendar year end unless they can establish a business purpose using another year end. So S corporation must allocate profit or loss pro rata based on the number of outstanding shares each shareholder owns on each day of the tax year. S corporations allocate income and loss on the last day of the year. So if a shareholder sells their shares during the year, they must use a pro rata allocation method to allocate income or loss. However, if all shareholders with changing ownership percentages agree, the S corporation can instead use the normal accounting rules to allocate income or loss. Now we'll go over the example given to us in the book and see how it works. So we know that Chance, which is one of the shareholders, sold his shares to Nicole, which is another shareholder. So, and this was on June 14th. So up until June 14th, they all owned a third of the shares. So using the daily method, what we're going to do is take 165 days up until June 14th, divide by the total amount of days in the year is 365, and then multiply by the total income. And each one of them will have 1/3, right? So the calculation is pretty much the same for January to 4th through June 14th. For June 15th to December 31st, things are different because we know that Chance sold his shares to Nicole, so his share will be 0. And now Nicole has 2/3 of the shares, and Sarah still has the same 1/3. But however, now we're using 200 days because that's what is the income here. So we'll take this calculation. We have 200 divided by 365. For Nicole will be 2/3. For Sarah will be 1/3. And we'll add this up to get the total allocation. However, if we use the normal accounting period, or sorry, normal accounting rules, then Nicole's allocation will be 1/3 of 100,000 because that's how much she owed then, and then 2/3 of 265,000 because she now has Chance's shares. Sarah's will be just 1/3 from the whole thing because her share didn't change, and then Chance, since he sold his shares in June 14th, he wouldn't take any of this, so he only will have 1/3 of 100,000 or 300. So, or sorry, 33,333. Lastly, we'll talk about separately stated items. We know that separately stated items are tax items that are treated differently from shareholders' share of ordinary business income or loss for tax purposes. We know that the character of each separately stated item is determined at the S corporation level. S corporation shareholders are allowed a 25% deduction for Section 199A qualified business income, calculated and subject to limitations that are at the shareholder level. Also, we know that shareholders may not hold stock in C corporations, and any dividends received flow through to the shareholders. However, S corporations are not entitled to dividends received deductions. Lastly, here is just a list of some separately stated items. There are more, but here are the major ones. We have short-term and long-term capital gain and losses. We have 1, 2, 3, 1 gain and losses, dividends, interest income, charitable contributions, tax-exempt income, net rental real estate income, investment interest expense, Section 179 deduction, foreign taxes, and then Section 199 qualified business income, allocated wages, and unadjusted basis of qualified property. So in conclusion, S corporations terminations create a short tax year for both the C and the S corporations. We must allocate the income between the C and the S corporation by using the two methods given to us, the daily method or the specific identification methods. S corporations that have terminated their status must wait until the beginning of the 5th year to make a re-election into the S corporation. For S corporations that were previously C corporations, all prior accounting methods carry over to the S corporations. We know that S corporations must allocate profits and loss pro rata. And then we talked about separately stated items, which are tax items that are treated differently from the shareholder's share of ordinary business income, loss, or loss for tax purposes. I want to thank you for listening to my presentation, and have a good day.